Hello all, and welcome to the April 2023 Economic Update. We're going to begin in just a few short moments, but before we do, I'd like to remind our audience members that they are currently in listen-only mode, but to please feel free to ask our expert panelists questions at any time, and we will answer them during the live Q&A session at the end. With that, I'd like to hand it over to Chris Larkins.
Thank you, Heidi. And thank you for joining us this morning or this afternoon if you happen to be on the East Coast. I am super excited to be joined today by Jason Draho of UBS. Jason is the head of asset allocation in the Americas for UBS's Global Wealth Management, and he's the chair of the U.S. Investment Strategy Committee. In this capacity, Jason oversees the strategic and tactical asset allocation recommendations for approximately $1.2 trillion in invested assets. So what we have with us today is a quintessential expert in what's happening in the economy, what's happening in the markets, and with very actionable advice that we can glean today for what business owners and business leaders ought to be doing based upon how assets are being allocated in the United States and quite frankly around the world. And along those lines, Jason is also a very well-known expert featured on CNBC and in other media outlets on these very same topics. Jason, thanks for joining us today.
It's great to be here, Chris.
Want to just kind of walk you through some questions that I know that our clients and most business leaders have top of mind. And more or less just to our audience, the way this will flow, I'll ask maybe 5-6 questions to Jason with some follow-up, and that'll take maybe the first 10-15 minutes of our webcast today. But please do add your questions to the questions bar within the GoToMeeting control bar. And after that first 15 minutes or so, I will ask Jason your questions as well. And we'll turn this into just a robust, almost fireside chat. So are you ready, Jason, for the first question?
Fire away.
All right. So I wanted to start with the banking crisis. But what's the latest on that? It seems, whether it's just the media cycles or our own perception, things seem to have calmed down a little bit over the past week or so. So is the worst over? Is this likely to be a problem for a while? How do you see things?
Well, it's definitely calmed down over the past couple of weeks. You know, when some of the situations first arose, starting really with Silicon Valley Bank, we've had a pretty aggressive response by policymakers, you know, in the U.S. by the Federal Reserve, by the Treasury, by the FDIC. They've learned from 2008, you know, that it's good to be, you know, kind of fast and aggressive in terms of what you're willing to do and support. They've had this sort of also kind of, you know, unfortunately, they've had the experience of developing these tools quickly. So I think they could kind of, you know, brush that off and sort of try to stem this, because, you know, if this escalates, it becomes a much bigger problem. So what we've seen is the markets, I think the bank situation kind of calmed down over the past couple of weeks. We can see to some extent in the data how much banks might be relying on sort of funding lines from the Federal Reserve. They're kind of coming down a little bit based on the data we got at the end of last week. There's still deposit outflows. What we can see broadly is just from kind of maybe smaller regional banks. We can't get specific data on individual banks, at least just yet. The Fed knows that, but, you know, the public doesn't at this point in time. But even those deposit outflows, they're still coming, but they're not as aggressive as they were a couple of weeks ago. So again, it sort of shines that like it's not getting worse; it's kind of getting a little bit less bad. And we know from past situations with bank crises, if things kind of escalate, they escalate quickly, or if they calm down, they end up being somewhat isolated. It doesn't mean there couldn't be a worse situation that materializes later on. Like there's always, you know, problems that could pop up. You know, in 2008, you know, not the greatest example, obviously, but you know, we had Bear Stearns, you know, went under in March of 2008. It was 6 months later before, you know, the crisis really kind of head on when Lehman went under. Again, this is not that kind of situation. You know, the system is much better capitalized, but it just sort of speaks to like we can't be sure until things have really kind of, you know, moved on. I think where the focus has started to shift is less about is there going to be another bank run or banks going under, but more like, okay, well, as the dust on that settles, what are the broader economic implications? We know it's going to impact some lending activity. We know it's going to, you know, impact maybe access to credit as banks have to kind of curtail some of their activity, at least in the short term. And so I think the focus in the marketplace has gone from short-term financial stress to medium-term, well, what are now the economic implications of all this?
So interesting, and a little bit more on that parallel between today and 2008. You know, part of the problem, of course, if we reflect back to 2008, were the, let's just call them bad bets that a lot of banks placed on mortgage-backed securities. And today there were some hints or some rumor, or perhaps just idle concern that Silicon Valley Bank made big bad bets on pre-revenue companies or venture-backed companies. And then you look at some of the crypto banks, right, that made big bets on cryptocurrency or on other types of cryptocurrency. Do you see any worrying parallels? I know you answered whether you think the worst is over, and the answer is, well, doesn't seem as bad, but take some time. But are there any parallels you see between the types of bets that banks made, for lack of a better word, now versus back in 2008?
So in aggregate, it's actually a very different situation, because if you go back to 2008, what ultimately became a problem for the banks is that they had a lot of called like toxic assets on their balance sheets. These were mortgages or mortgage-backed securities that were backed by mortgages that ultimately like people just defaulted. So they were kind of bad quality assets. They were illiquid. They couldn't really move them anywhere, and it was difficult to kind of price them. So this is a kind of a bad combination of attributes. This time with Silicon Valley Bank, really what the problem was is that, in the past couple of years, a lot of their clients, companies in Silicon Valley, they were flush with cash because there was so much sort of money out there. They go and they put all these deposits with Silicon Valley Bank. If you're then Silicon Valley Bank, it's like, well, we got to do something. We got to take this money and invest it somewhere. A lot of what they did is they ended up buying treasury bonds, mortgage-backed securities, kind of guaranteed by Freddie and Fannie, which are basically government guaranteed. Very high quality assets. They're going to get their money back. They're liquid. You can trade them in the marketplace, and you can price them, very easily. So almost the polar opposite of the problems of the assets, from 2008. The problem, and I think this is more of a bad management on Silicon Valley's part, is that they didn't really understand or fully kind of hedge the interest rate risk. Because what happened is that they bought these assets when interest rates were like the 10-year treasury yield was like less than 1% in some cases, and then it rose all the way to 4%. So as interest rates go higher, prices of bonds go down. So they had sort of essentially mark-to-market losses, of like $18 billion. So if they had to sell all those assets, it would wipe out their equity capital. So they just didn't manage, they've managed the credit risk exposure. They did not manage the interest rate exposure. But this is kind of almost banking 101. They didn't do a good job of that. I think other banks don't have anywhere near those kind of issues. So again, it sort of gives, sort of comfort that that was more of an idiosyncratic management of a risk that they should have been able to take care of that isn't really representative of other banks. Now, there could be other problems, but I think that kind of problem that, kind of ultimately with the downfall of Silicon Valley Bank, you just don't see that kind of, similar business model or practices elsewhere.
Interesting. And I had read an article in the Wall Street Journal not too long ago, maybe a week and a half ago, speculating about whether some of this might spread even to the private equity markets, and some of the bets they may have placed with large institutional funds, right? So have you, is there any indication that there may be concern there, or is it maybe just speculation at this point?
Well, I think within the private landscape, there's kind of concerns about your private credit more so than private equity.
Okay.
One of the consequences going back to 2008 is that, well, you have a lot of banks said, well, given the tighter regulations, we're just not going to lend to certain kind of companies or businesses, or the credit conditions or terms are going to be onerous. So you had essentially non-bank entities step forward and say, well, we'll fill this market. So it's sort of unregulated. It doesn't have some of the government guarantees. And that marketplace, the total amount of sort of private credit has gone from very ballpark figures, let's say, 500 billion, say back in 2010 to now, let's say 1.5 trillion. So it's gone kind of multiple in size increases. It's not as transparent. These are not securities that trade on a daily basis, so we don't know like the overall quality, if it's deteriorated or not. So it's more of the lack of sort of clarity, sort of the opaqueness of that market that sort of raises, well, we can't really see things, so we don't know if things are perfectly fine or they're good, or they've kind of managed those risks well, or if there could be issues, kind of down the line. Anecdotally, we know that the lending conditions, the criteria were pretty solid. They tend to be kind of one-on-one type of action. So you can have a situation where, even though it's credit, you can kind of renegotiate terms. So basically, kind of almost like lend and extend. So you basically don't have to have situations where you got these massive defaults. So again, this is there's not a lot of data where you can really say definitively this is the situation, and we can have complete confidence. But at the same time, it shouldn't be a big issue based on sort of what we know, at least anecdotally. I think for the private equity side, and this probably maybe applies a little bit more to, even to venture capital, the growth space of private equity, is that, you had massive run up in valuations for some of those assets in the past couple of years. Companies that were able to raise money up until early last year, they're good for 12 to 24 months. But if I have to refinance, you're seeing like down rounds. I think sort of valuations maybe haven't been fully marked in the private sector as much as they need to be to some extent, more so than the public markets, which, the markets kind of very quickly will sort of take those valuations down. I think for those big private equity firms that are raising capital, it's a difficult environment to raise money because there's probably already a lot of dry capital that needs to be put to work. And one thing that sort of drove the allocations to those kind of investors over the past decade is that, well, where do you get returns? You're getting nothing in the public bond markets because yields are 2%. Now, if I can buy a money market fund that's giving me 5%, and I'm a big pension fund, it's like, well, why do I need to put a bunch of money or allocate so much into that space? So I think that's kind of going on. There's a little bit of, maybe over excessive activity, over building up over a decade. Now it needs to sort of kind of right size. I think that's more of a structural aspect of the marketplace, more so than a real kind of crisis situation.
All right, thank you. So how does this crisis impact the economic outlook? It seems like we've been hearing about the recession for quite some time, and it doesn't quite show up in the data. It's almost like the recession that never came. Do you believe one is now inevitable?
Well, definitely, it's the most predicted recession. I think, in June of last year, that's when people started to become more consensus, like this is going to happen. Economists were forecasting it, something like 60% were saying it, which is, usually it's always around a third, and somehow economists are caught off guard to some extent. This time, it's like the most anticipated forecast of recession that has yet to materialize. And, one still could materialize, but if you look at what's going on in the economy, there's definitely some slowing of activity, which is you'd expect. Right? This is the goal of the Federal Reserve when they raise interest rates almost 5% over the past year, that they're trying to, cool things down, bring inflation down. They want growth to slow because the level of activity before was simply unsustainable without inflation just sort of perpetually being too high. So some moderation is what we'd expect. But if you look at the data, and I think the labor market is the best example, you're seeing some moderation there, but the unemployment rate has barely budged, still around 3.6%, and it's been between like 3.4 and 3.7 for the past year. Over the last year, the total number of jobs created is around 4 million. That's not a recession-like condition. That's a booming economy typically. We'll get numbers on Friday for the March payroll, which will be the first time we can say, well, could there be some impact of all the banking crisis? Expectations are still around 200,000, which is a really healthy level overall. That will probably pull back in the coming months. But again, that's sort of what we'd expect over time to happen, not necessarily signs of recession. We're still seeing consumer spending is holding up reasonably well. And what will happen also is, inflation is going to start to moderate. So the drag of high prices for the past year, at least the rise in prices, has become less onerous on consumers. So I think the trend is slower. Now, the credit conditions and what's happened to the banking system, it definitely adds downside risk. The hard part is estimating just how much, because you have to figure out, like, well, how much could lending kind of be curtailed? How long will it take? And even if it's curtailed, is that going to lead to bigger layoffs in companies? So it's a hit. Maybe takes all else equal growth down like another 0.5 percentage point. Does that push us into recession? I think that's debatable. I think a hard landing, a really kind of deep recession, still looks quite unlikely. Something between a softish landing and a mild recession may not look a whole lot different. And if you're running a business, it may be kind of similar. It ends up being kind of a muddle through for a few quarters, and at some point middle of next year, things start to recover. I think that's a reasonable base case. But the hard part is the banking situation. These are things that are they're good until they're not, as we've learned with Silicon Valley Bank and other banks run. So it's a non-linear situation where you're fine, and also you can kind of fall off a cliff. And that's really hard to predict if that will happen or when that will happen. I think that's why it could be okay, but there is some chance of a greater downside. I just think right now, though, given the momentum of the economy, given the overall health of the private sector, if we get a recession, it still feels to me like this is not going to happen until late this year, like the fourth quarter or next year. I think there's too much momentum for the near term, barring some kind of other big shock to tip us into recession that quickly.
Interesting. And you mentioned inflation, and it has been falling, but it's still historically too high. And there are other sectors, and many of our clients in some of these sectors, particularly as it relates to transport costs and some of the supply chain costs that they were encountering during COVID, they're actually seeing disinflation, and that's what's on their mind is the reversal of this. Where do you see this going? Where do you see inflation going, generally speaking, and in what pockets might business owners need to be a little bit more focused on the threat of disinflation?
You're right, Chris, that inflation is coming down. Last month, the last data point we got in February was at 6% as kind of headline inflation numbers. Next, I think Thursday, we'll get the March number. expectations that it's going to fall to closer to 5%. And really over the next few months, we're going to get a pretty sizable decline in headline inflation. And the reason is almost just sort of basic kind of math that last year inflation and prices surged because once the war in Ukraine began, you had like commodity prices surged, things like that went up. So you had a big shift up in the second quarter of last year. So we're starting from a higher base, which means that a year-over-year effect, it's just going to be a smaller measure. So you're going to hear headline inflation come down. So by the summer, it could be like 3.5%, 3%, which might surprise people. That like it's going to sound like, well, inflation is starting to be solved. Now, when you go to the core measures, which strips out energy and food, which still matter, but I think from the Fed's perspective, they really focus on core inflation because food and energy are very volatile. The core stuff is things that are stickier. And on that front, there hasn't really been much improvement on inflation. Whether you measure the last 3 months, can you take the 3-month inflation increase and sort of annualize it over a year, 6 months, 8 months? It's all running a little bit over 5%. So those measures haven't really changed. Some of it should. I mean, a good chunk of that is shelter inflation. And we know that rent and housing prices are kind of not only coming down, but they're growing less than they were a year ago. So at some point that's going to flow in, but not until later this year. So there should be some improvement. You gave the example of people who are experiencing disinflation, those who are like supply chain, those have improved a lot. Shipping costs have come down. If you kind of break out the core measure into kind of goods inflation, that stuff is kind of back to where it was pre-pandemic. And in fact, it might even be disinflation in some cases, because those massive surge before went up. Now those kind of supply chains are healing. Also, consumption has shifted away from people buying stuff, TVs, cars, whatever it might be, to like taking trips. So the demand has fallen, the supply has improved. So you've had improvement in inflation there. But the problem or the issue for overall inflation measures is that core goods stuff is maybe a third of the overall inflation story. The services part, that's where you're still seeing sizable inflation. If you're buying travel and air flights for the summer, I think you're seeing the prices have not come down very much. Same thing with hotels, things like that. So those are a big chunk of the inflation basket, and that really hasn't improved. Now it should, but it might take a case where like growth has to slow more. Maybe you even need at least a mild recession to really get inflation down to levels where the Fed can say, we're comfortable. So the direction of travel, headlines improving, other parts should get better, but it's not going to be a smooth kind of ride kind of down from here. There's going to be some fits and starts. I think the direction of travel, the worst of inflation is over, and it could even get to the point where it's sort of solved from the Fed perspective without a recession, which would be the ideal outcome. But again, a lot of things will have to go right for that to happen.
Yeah, and you mentioned the Fed, and that was actually going to be my next question. So great segue. What do you think this means for interest rates? They've been jumping around in the market, at least a great deal for the last month. What do you expect the Fed to do for the remainder of the year?
Well, if you think about the implications of banking crisis across the economy and across financial markets, the biggest impact it's had is actually on the short-term interest, I think the 2-year Treasury yield. At some point, from around March 8th to about 2 weeks later, fell 130 basis points, like 1.3%. And there was days where it was up or down around 40 basis points. This kind of volatility for a 2-year Treasury yield is, I wouldn't say it's unprecedented, but the last time we saw anything close to that was in the early 1980s, so a long time ago. And if we go, again, before Silicon Valley Bank became an issue, or kind of, on the public consciousness, Fed Chair Jay Powell was in DC, testifying before Congress kind of on a semi-annual basis, giving an outlook for the economy, and also indicating to people in Congress, but also really to investors, that the Fed intended to raise rates, even more than they sort of outlined before. And so the market, was expecting like probably 4 more 25 basis point hikes. We got one a couple of weeks ago, but once Silicon Valley became a problem, with the banking crisis kind of emerged, we've gone from expecting 4 more to now the market's basically saying 50-50 that we get another hike at the beginning of May, and already by June or July the Fed might start to cut rates, and so by the end of the year they've cut rates a couple of times. So a pretty big pivot in terms of the market expectations. It's at this point it's almost sort of a binary outcome. If you don't get a recession, if kind of growth is holding up okay, we don't see job losses or any significant job losses, the Fed might kind of keep rates around 5% as long as they can, to be comfortable that inflation is coming down, and then gradually lower interest rates next year. If it looks like the economy is tipping into recession by the summer or the fall, chances are they'll cut, and history tells us when they start cutting during a recession, they can cut pretty aggressively, meaning they go from say 5% down to maybe 2% in a matter of 6 months or so. So it's almost like those two outcomes, and the market's pricing kind of putting a probability of like someone this will come on, someone this will come in, and then we end up somewhere in between. So it's hard to say it's like either one or the other to some extent, as opposed to the muddle through. And right now, I'd say, more likely they're going to try and hold steady. But it all depends, like, when that recession does materialize, if it does materialize, then I think you'll see a pretty sharp drop in rates. The key point, though, is that we're at close to the peak. There's not much more. So maybe one more hike, and then it's really kind of downhill from there. It's just a matter of like, when does it start to kick in?
So would you advise business owners that are working with adjustable lines of credit, let's say, right, or that might be pegged to the Fed rate, would you recommend that they kind of hold and wait and perhaps not panic as much? It sounds like your longer term outlook is at some point the Fed's going to ease. Is that near term? Is that medium to long term? What's your perspective?
So I think of it, you can think of it from a perspective of like a treasurer who's thinking about their financing costs and borrowing, but also like, day to day, I'm dealing more with investors thinking about what's their investment portfolio doing, which applies, I'm sure, to everyone on this call. A lot of people have been saying, like, well, why should I buy risky stocks or other investments when I can sit in, I can get a CD that's paying me like 5%. That's not a bad, interest payment, which is very reasonable and understandable. The point and the advice that we're giving to our clients now is that if the Fed is close to done, or maybe they're already done, then the direction of travel is rates are lower. So if you bought that 3 month, 6 month, 1 year CD, great, you locked it in, but then there's going to be a reinvestment risk. You're going to be kind of turning that money over into lower rates. So you want to start thinking about diversifying out of cash into other areas. That same logic is, it kind of works in a different way, that if you are been borrowing, you might also want to think about, if you wait a little bit, maybe those kind of short-term funding costs, it might come down later this year. But the flip side, though, is as that happens, it's also a situation where if it's going on, it's probably because the economy is in a difficult situation. So you have to think about the other parts of your business. So there's an also element of, if that's the case, you might want to, draw down credit lines. Make sure you have enough kind of cash buffer to kind of get through those situations. So it really depends on the situation you face of your business operations, of your finances. But I think the idea is that rates are probably peaked. As they come down, though, it's probably coming down because economic conditions deteriorate. So you kind of have to balance those two factors.
Interesting. So then, take all these different factors. When you look outside the U.S. economy, so you basically look at everything that's going on here in the U.S. and perhaps North America, but when you look outside the U.S., what other factors you're monitoring most closely? Which of those would be relevant for the U.S. economy, or most relevant that our clients, business leaders, business owners on this call ought to be paying attention to?
Well, we can kind of travel around the world and think about what are some different developments. Most recently, what happened over the weekend was you saw Saudi Arabia and some other major oil producers, kind of OPEC plus, sort of voluntarily curtail their production of oil, with the idea that they want oil prices to go higher. We saw Monday morning oil prices were up about $5 a barrel. So there's, I think, a risk that given kind of these supply issues and sort of almost voluntary supply side cuts, that the price of oil could go a little bit higher. We're not going to, it's unlikely we're going to go back to $120 a barrel like we were about a year ago when the war in Ukraine first began. But there is that sort of factor, which, I think if you're, the Biden administration certainly, or if you're like the, Jay Powell, the Fed, anything like that it's inflationary. It's obviously, not great politics when gas prices go higher. So I think just watching the geopolitical dynamic of kind of, what's going on there and the desire to keep oil prices, that's something that would have, an immediate tangible impact on the U.S. economy. Not necessarily large, but it could be, have some, it's complications that, right now are probably not warranted or wanted by any policymaker. If we then go to the situation else, in Europe, things have been better there than sort of expected if we went back 6 months ago. The thought is, without Russian natural gas and other energy supplies, Europe would have a long, cold, dark winter. That wasn't the case because the weather was unusually warm. And now you're seeing data coming out of Europe and parts of Europe that is showing things are, they might avoid a recession, even doing better than the U.S. economy, at least on a relative basis. There's that risk that things could escalate in Ukraine. That's a really hard thing to predict. So there's always a little bit of existential uncertainty in Europe. But things on that front look a little bit better. You can travel to China. The reopening is kind of picking up steam in terms of economic activity. I think it'll become more evident going forward. In the past, when China's growth has sort of reaccelerated, it's been such a big sort of impulse that's helped kind of lift commodity prices. It's helped lift sort of the global economy to some extent. This time will probably be a little bit different, mostly because what's going on in China is sort of what happened in the U.S. when kind of the things really reopened and people kind of normalized their behavior. Is that they just went out and did stuff, and you're seeing like mobility metrics, people like taking trips and driving and China are higher than they were pre-pandemic. They're just, after 3 years, they're kind of happy to kind of get out and about. So it's good for the domestic economy, but it's not like they're going out and buying a bunch of commodities because they're going to build more, apartment buildings and bridges and things of that sort, which tends to have less than impact on the U.S. economy. So when you kind of add all these kind of factors up, I think there's things that are relevant at the margin for the U.S., but I think that the driver, what's going to happen here, is really what happens with the banking situation, whether that gets, kind of stabilized, whether it gets worse, and then how do the policymakers and how does the Fed sort of kind of balance all the things that they have on their plate at this point in time, which last year was a difficult problem with inflation, but they could focus solely on inflation. Now they have to worry a little bit about this financial stability, and those are kind of risks. And if the economy does slow down, then they have to worry about, like, well, now unemployment can go up, and where do we kind of balance all those things? The more things you have to balance, like if you're a juggler, the more the risk that you have, you drop one of those balls. When it's only one, I think you can be, you just kind of, you can hold steady. So I think it's really, these are all sort of a lot of noise, but I think the bulk of what's going to happen in the U.S. is really more domestically kind of determined.
So then when we look domestically, how about differences in sectors, right? So if we look at industrial, manufacturing, tech, construction and housing starts, what are some of the differences maybe you see between some of those sectors, some that might be a little bit stronger today and others that might be more dependent on what the Fed does next?
Well, let's kind of take them one by one. Industrials is a good example because industrial tends to be a cyclical sector. When the economy is accelerating in the U.S. and globally, they're levered to that. You think of like a company like Caterpillar, so it's a classic industrial company. In an environment where it looks like the U.S. is slowing, in other parts of the world, are at least not growing rapidly, that shouldn't be necessarily a good environment for industrials. But what's also going on is, against this sort of this cyclical maybe headwinds, is secular trends that are really favorable for industrial companies. A lot of investments taking place, because of reshoring or sort of deglobalization as manufacturing and production comes back to the U.S. We alluded to earlier supply chains. They've unclogged. I think a lot of companies are realizing we need to diversify our supply chains, maybe reshore, not in the U.S., Mexico, Canada, something like that. There's also the energy transition that's sort of taking place. A lot of companies believe we need to have secure lines of energy. Also, with the Inflation Reduction Act, a lot of essentially government subsidies for investment in kind of green energy and sort of the energy transition. So these are things that are not cyclical, they're secular that are taking place. So I think industrial companies, a lot of them are kind of poised to benefit from that. The question is like how much between these two forces, kind of how do they counterweight? So if cyclical is not too strong, then these secular trends could keep this positive momentum for that sector. But if it turns out the cyclical headwinds are stronger, then it's going to ultimately, these companies will kind of curtail, at least in the short term, some of their activity. So that's industrials. If we think about technology, from just a market perspective, tech stocks, especially the large mega cap tech stocks, did very well in the first quarter. They were up around 17%. Like the Nasdaq was about 17%. The S&P was up 7%. If you stripped out 7 companies, though, like Microsoft, Apple, Google, I think Tesla, and a few more, out of the S&P 500, the S&P was up only 2%. So it was really like those 6 or 7 companies that was really dragging kind of everything higher. So there's been a kind of a little bit of crowding into them. Maybe it's kind of a flight to safety, a belief that these are kind of safe haven, really kind of, generate a lot of cash flow. There's also been driven by optimism about the whole AI kind of revolution that we're seeing. That's now, I think people can tangibly see some of these benefits. But one of the consequences is that as a sector, it's made things pretty expensive. Like just as if you're an investor, to the level that we haven't seen since 2000. Like so these kind of some tech stocks specifically versus the overall market. Generally speaking, when that happens, things ultimately kind of mean revert. The timing of that could be uncertain, but I think some of the challenge we kind of mentioned earlier with like Silicon Valley Bank, the access to capital, so the excess in the industry, I think that hasn't been fully played out. If you want to use an analogy, the dot-com bubble took 2 to 3 years to really unwind, and there was definitely some rallies in that period of time. What we saw the past 3 months might be one of those rallies before things again continue to sort of derate a little bit kind of going forward. It doesn't mean there's strong secular tailwinds, but just to kind of know that there's a lot of kind of maybe excesses to some extent that were built up. You touched on housing, and the construction. Again, it's sort of very, very hit or miss, depends on where you are. It's interesting to see that, because mortgage rates went up so much, demand is curtailed, but also supply is curtailed because existing homeowners don't want to sell their house, really have a 3% mortgage and buy something new that's going to pay 7%. Like it's a very reasonable thing to do, which is probably provided some support for, the housing market. There's also demographic trends that support it, but I think it's going to be, continued kind of pressure in that space. And given that sort of construction kind of starts versus kind of new kind of demand is sort of shifting the way that we probably need to build less going forward, at least until that sort of demand comes back. I think that keeps some headwinds there. And just finally on the commercial real estate side, a lot of headlines there, especially tied to the banking situation. The challenge is most acute for office, but these are challenges they faced even before the banking crisis, because in this return to work or office environment, you just have a lot of buildings like, well, do we need all this office space if people are going to be working at home 50% of the time? And this just sort of exacerbates some of those issues. But commercial or office is only really about 15% of the whole commercial real estate market. So the headlines look really bad. I think it very much depends on exactly where you are, what kind of buildings you have, and what part of the real estate space you're in. So it's not kind of a catch-all at all at this point in time.
All right, so I've got two final questions for you. The first one of the last two really builds upon your comments here, sector by sector. So if you just take this macro, you take the macro outlook, and really everything you commented on here today, what's your overall investment outlook?
So I would kind of characterize it as we're kind of calculating where we're going to take positions. We're not overly cautious. A couple of weeks ago when we updated our kind of overall view of the markets, we downgraded our view of equities, broadly speaking, and upgraded our view of fixed income and higher quality bonds, like things that are having low default risk, investment grade corporate bonds, things like that. And it wasn't necessarily a really pessimistic view on the stock market. It's more of, well, if I were to have $1 today and I have to sort of lock it down for the next 9 months through year end, what kind of return can I expect if I buy the S&P 500 or I buy, single A rated kind of corporate bonds? And with the S&P now trading over 4,000, our expectation is going to end the year around 3,800. You could say flat to a little bit negative, which means like you're not getting a lot of or no return, and you'll probably get a lot of volatility between now and then. So I called it like you're getting returnless risk. That if you put that dollar to work there, whereas if you buy investment grade corporate bonds, not the most exciting asset class, but you could buy kind of clip that coupon through year end and get about 5%. So low, decent return, but also a lot less volatility. And just looking at the valuations, the S&P 500, the forward multiple is over 18. That's a pretty high multiple by historical standards. It's only above that level less than 20% of the time, which means things have to go really, really right to sort of justify that valuation, so that earnings are far better than expected. Interest rates are able to decline. Possible, but the odds of that happening are not great. So it's used, they're kind of priced not for perfection necessarily, but definitely for a very benign sort of soft landing outcome. Whereas bonds are already kind of pricing in, I think, a decent amount of recession risk. So it's a little bit more kind of cautious on the view of the markets. Kind of buy quality assets. Be a little more defensively positioned within equities. Because we may not get a big storm, but we're definitely getting some headwinds. I think better to be kind of tacking a little bit closer to home and not taking excessive risks at this point in time until we really understand where are we coming out on the other side and when are we going to come out on the other side.
And bringing that same outlook to our audience of business owners here today, and the expectations will be a soft landing, a hard landing, or somewhere in between. What actionable advice do you have for business owners?
So I think one is, to be prepared for, the situation getting kind of worse, because that's a hard thing to predict. We know it's going to slow down, but how much it's hard to know. Because of the banking situation, if you're a small business in particular, if you're banking with a smaller regional bank, it's a very rational thing. And where you've seen this, like people moving their deposits around, diversify their deposit base, because you don't know, you don't want to necessarily take your company's life and sort of, health or your personal career at risk of just sort of riding kind of through. You probably want to build up some kind of cash buffers to, kind of get you through if there becomes a little bit more of a kind of a credit crunch later on this year. So I think that's, kind of a very sort of tangible, kind of clear kind of consequence of what's happened with the kind of the banking crisis, overall. The other thing I'd say, it's going to depend on the nature of your business, but kind of goes back to what we talked about with interest rates. They've probably peaked out to various extents. And so think about as they come down, how does that impact your financing overall, how much you want to invest, or how much also understand if it's coming down, why is it coming down and where that could impact my business. So you almost a little bit of scenario planning to figure out, if this happens, then it's because of this, and what does that mean if this over here happens. So I think those are some of as a general statement across kind of all types of different businesses in different areas. Those are some of the kind of the key messages I would have for them.
And for those that are holding large stocks of inventory, as you look at the inflation outlook, just kind of revisiting some of your comments earlier in the webcast. How would you advise the business owners properly hedge that, or at least what should they be paying attention to so that they can manage their inventory and the size of their inventories accordingly?
Yeah, I think it really depends on, kind of what type of inventory and where you are in the economy. If it is, consumer discretionary type of goods, I think there's maybe a little greater risk that kind of demand could fall off. If you're in areas where there's more of a long-term structural sort of trend or demand, like going back to my comments about industrials, there might be a temporary pullback, but there's a lot of sort of secular structural forces suggesting, this needs to be, say, more investment. So I think kind of calibrating, what are the different sort of factors that would drive demand? How much is, very sort of cyclical versus how much is sort of has a structural element that, yes, this may pull back, but we just see, this kind of playing out over a few years, because that would give you some confidence that, well, whatever happens in the short term is sort of temporary versus, this is just sort of a normal cycle and demand's going to moderate, and we can't be guaranteed that things are going to come back very quickly. So it's, I think, understanding the drivers of the demand for your business and how much of it is, reflective of temporary economic conditions versus something that's kind of fundamentally different.
Yeah, that's really profound. And a lot of the advice we give to our clients is don't believe necessarily the historical trends you saw in your business as they relate to inventory. The situation, every situation really is unique, but remaining closer to the drivers of your business, as you say, and not just supply and demand, but the KPIs and the benchmarks across your industry or your market segment really is key to understanding how to control those. We covered a lot of ground here, Jason. Super interesting information. Is there something we didn't cover? Is there a question I didn't ask that perhaps you want to add to your commentary?
No, I think we know these are all the big picture topics that I'm, discussing with other clients, that I'm asking, other people, like, other economists, like, how are you thinking about this? Is how I'm thinking about things. This is really kind of the crux of the, the situation, the banking situation. What does it mean for kind of growth and inflation going forward? How would the Fed respond to that? And then, for me at least, thinking about the investment implications. But I think those are the key issues. A couple, maybe one final thing I would sort of touch on. We often get questions about the debt ceiling, and that will certainly be, building up as we move into the summer, because the expectations are that at some point, like, the Treasury will kind of run out of funding where they, use their emergency measures. We don't know the exact date, but it's probably not before, the beginning of July. July or August is some sort of kind of time frame, which, given the sort of the political dynamic and sort of the polarization and sort of the lack of bipartisanship in DC, it is like something that's likely to come down to the wire, unfortunately, which will create a lot of headline risk. And I think relative to other times where this has happened, the risk of something, maybe in the middle of the night breaching some sort of covenant, and then by the next morning kind of resolving that. So I think that exists. But the actual economic impact ultimately ends up being, kind of relatively minor. Even the financial market impact is, going to be relatively minor. I think, if something happens, I think then cooler heads prevail, and some solution will be achieved probably at the very last minute. But it gets a lot more political play and headline noise, and I think the actual real economic or market impacts that have any sort of real lasting impact. So we'll be talking about a lot in the coming months, but I think probably more than it's actually warranted based on the actual sort of fundamental consequences.
Well, thank you. And I'll note for our listeners that we at CEO Coaching International have on our website, ceocoachinginternational.com, various tools and resources that you can use, that you can apply to your business, such as a recession checklist. If some of Jason's commentary struck a chord with you, perhaps, what we recommend for every business owner, just as you mentioned, Jason, is don't take things for granted. Ask the provocative questions, ask the disruptive questions. Don't assume that the scenarios are going to play out the way you did in the past, and be a lot closer to those drivers of your business. So that recession checklist, a cash bridge to help you shore up cash, to help you look at your cash and credit situation. We have those resources available complimentary on our website. I would also put in a plug for, this is such a great webinar. We have other webinars which are scheduled. They appear on our website. And we also have a masterclass on negotiation coming up in May that you can learn more about on our website as well. And we have a Harvard Business School resource for that seminar. Jason, I really want to thank you for spending time here today. You touched upon all of the information in your answers that ended up being questions on our audience's mind. So want to thank you for your time. Thank you for this wonderful information. and hope to have you back real soon.
You're welcome. Yeah, happy to join anytime.
Thank you.